And welcome to the Shades of Green webinar. I apologise for any audio issues that we were experiencing a little bit earlier and hope that you can all now hear us. My name is Leah Willis and I'm Head of Client Relationships here at Australian Ethical, and I'm delighted that you could all join us this morning for this interesting webinar on the rise of ethical investing. I'm also joined by our colleague, Dr. Stuart Palmer, who heads up our ethics research here at Australian Ethical, which underpins all of our investments and our business here, and will share with you some insights around how you actually navigate this really interesting rising area of responsible investing. We know clients are demanding more of it, and we know there's a rising popularity of products coming to market every week here in Australia. So to know what is the difference between ESG, SRI and ethical, this morning I hope will shed some light on the differences, some of the benefits, and how you can actually navigate this for your clients to make sure that you're making the right product decisions that are aligning with the values that they're trying to achieve through their investments. I'll just quickly touch on some housekeeping items this morning. As part of the webinar, you'll notice a tab with Q&A at the bottom of your screen, and we encourage you to type any questions along the course of the next 30 minutes where Stuart's presenting, and we will double back and answer as many of those as possible at the end of the session. As always, I need to provide you with the legal upfront that this information presented today is only general advice and it's not intended to substitute for personal advice. With further ado, I will pass over to Stuart to give us some insights into the rise of ethical investing and what it means to be ESG, SRI or responsible, and how you can actually navigate that. Thanks so much.
Thanks very much, Leah, and thank you very much everyone for joining. I'm going to try and run through this pretty quickly to give the opportunity for plenty of time for questions, because I think there are a lot of areas we can go deeper on where you do have those more specific questions. Leah sort of introduced it perfectly. There's a lot of jargon out there, a lot of labels out there: socially responsible investing, ESG, there's sustainability themed investing, ethical investing, impact investing. So we're going to try and navigate the differences. I guess my expectation management warning up front is that there are no clear definitions of these terms, so I'm not going to be able to offer those to you. But what I want to explain is the sorts of differences that they do pick out, and how it's important to look behind the specific labels to understand how the funds are approaching responsible investing, and then whether that approach is aligned with what your clients are after. I mean, we know a lot of money is going into these investments, so it raises the obvious question: why is that? A lot of talk about millennials. They're people coming of age around 2000 and sort of the next decade, coming of age, making choices around superannuation of investments, being much more attuned to aligning their consumption choices with their values, and that's translating into also looking at their investment choices and how they might align or not align with their values. But we're seeing it as not just a generational thing. Here's some results of a recent survey from the Responsible Investment Association of Australasia, showing that 92% of all Australians surveyed expect to invest responsibly and ethically. So it's a broad-based change. Of course, we know that surveys are different to action. So some of the people who expect to invest responsibly and ethically won't, of course. But we are seeing still a lot of it translate into action. So starting at the global level, over the past 10 years, really significant growth in the broad class of what we'll call responsible investing, and I'm going to come back to the different categories of that. Australia, a small sliver of that, but we'll drill down into the Australian experience more. That only takes us through to the end of 2016. The 2007 data globally is still being collated, so I don't have a number for you on that. But we've got more recent data from the Responsible Investment Association of Australasia about what's happening here, again, doubling around every 3 years. This is a category that RIA, the association, defines as core responsible investing. I'll explain what that means in more detail shortly. But again, doubling around every 3 years. There's a big jump in 2017. So what happened then? Well, AMP introduced some screening across all their funds. So they excluded from all their funds tobacco, and they excluded certain types of weapons, cluster munitions, chemical and biological weapons, and landmines. So some fairly specific and limited screens. Great to see them doing that across all their funds. Adding those to that core responsible investment category resulted in a big jump. But yeah, that doesn't explain all the continuing growth. If we look at some research from KPMG, looking at last year's growth, top performing funds in terms of AUM growth and in terms of member growth, Australian Ethical Super, that's us, showing up as number 2 in terms of AUM growth. We point out that that's highest organically growing fund. Tasplan grew through merger. So whilst the industry generally, in many cases, is experiencing net outflows, the ethical sector of superannuation and investment more generally is certainly growing. So, yeah, I guess I want to talk just a little bit more about what's driving awareness of ethical and responsible investment, and why we're seeing it delivering both on people's expectations around aligning investments with their values, but also their expectations, obviously, around good financial returns to help safeguard a more secure financial future. So here's 3 organisations, August organisations, CSIRO, KPMG and PwC, identifying megatrends. These are the things that will influence the future, picking out some of the great challenges facing the world, but also some of the great opportunities. So I'll let you digest a little bit of that, but I guess in terms of some key themes jumping out of that, we've got sort of demographic change. Obviously, aging population is a big development. We have technological disruption everywhere we care to look, whether it's in the IT sector or the energy sector or the food sector, and a real recognition of the challenges of dealing with massive growth in the amount of waste that as a society we produce and need to dispose of, whether currently a lot of it going to landfill. How can we reuse? How can we recycle and change that trend? So I think the greater general public awareness of these challenges, coupled with, for many, a frustration with government action to meet those challenges, is translating into people looking at, okay, what role can private capital, private investment play in meeting these challenges and exploiting these opportunities? And yeah, how can I, as an individual, through my superannuation investment or my other investment choices, make a difference? And yeah, the story is pretty compelling. Ethical portfolios which do look to invest in a way which encourages a more positive future are aligned with those trends and the opportunities, both the opportunity side that those trends create, but also helping them navigate often away from the risks of disruption, which some of the industry sectors which have more negative impacts carry. So you know, some key elements there that certainly we focus on: investment opportunities in energy efficiency. There's a lot of talk about renewable energy, carbon-free energy, which is absolutely crucial. But if we can actually invest in technologies which reduce energy usage in the first place, more efficient products, we can have more efficient packaging, then obviously that can be an extremely effective way of dealing with those challenges of climate change which we're all acutely and growing sections of the public are acutely aware of and increasingly concerned that insufficient action is being taken. So I guess the question arises, and we'll confront it head on, what does that mean for financial returns? Our growth is certainly being driven by people looking to invest for a better future, but they're also very clearly looking for a financially secure future for themselves as well. And there's been talk of an ethical investment myth for some time about ethical investing involving some sort of trade-off between returns and positive impact. It hasn't been our experience. This diagram presents the experience of just one of our funds, our longest lived fund, the Australian Shares Fund, mapping there on the vertical axis returns, horizontal axis risk as measured by annualised standard deviation, and then plotting the Morningstar universe of Australian share funds according to their risk return characteristics, also showing you some key benchmarks, the ASX 200 industrial and a couple of others. So that's a good story. We're seeing higher returns and for lower risk. So I guess what's not to like about that? That's a particular fund story. If we look at actually how that's played out in the returns from that fund, there's a nice graph showing that over the long term, since inception, that fund has generated strong returns against key benchmarks. Looking beyond sort of that specific fund experience, Australian ethical experience, here's some information which some of you will be aware. The Responsible Investment Association, let me refer to them as RIA from now on. They do an annual benchmark report where they look at the state of responsible investment in Australia. They do some financial analysis, return analysis on a subset of responsible investment funds called core responsible investment that covers more ethical style funds, also sustainability themed funds and impact funds. I'm going to delve into the definitions around that shortly. But in terms of comparing the returns of those funds, that's the top row in each of those boxes, against fund averages and then against indices. So just if you look, let's just compare them then to average funds in their sectors, and they've looked at Australian share funds, international share funds, multi-sector growth funds. You'll see, looking at that second column, over 8 periods for those different sectors, we've got outperformance by the core responsible funds. In 2 cases, the performance is broadly in line. That's the orange. And in 2 cases, there's been some underperformance. So, a positive story for core responsible investment, that it doesn't involve any sacrifice in returns, and obviously that analysis suggesting the opposite. So let's drill down into different types of responsible investing. It's a really broad label. So what are some of the different aspects to look at if you're trying to choose a fund, or a client is trying to choose a fund? So this is how RIA breaks it down. They look at the investment market generally in Australia, and they firstly identify a big subcategory of what they call total of responsible investment. So that's sort of, as they define it, funds which at a minimum are effectively integrating ESG into their investment process. So ESG is environmental, social and governance concerns or issues. So funds which are assessed to be, in a tangible way, doing some integration of those considerations into the investments. That's the total responsible investment number, around half of total investments now, which is great to see. They then pick out a subcategory, which is what I've referred to so far as core responsible investment, and that includes 3 types of funds. There's those managers who are screening, so that means that they're screening in companies, investment sectors out because of their negative impacts, and or positively screening in companies because of the contribution they're making to a better future because of their positive impacts. The second category is sustainability themed investments. So that might be a clean energy fund, a low carbon property fund is another category of fund classed as core responsible investment. And lastly, impact investing, community finance, a smaller subcategory. I'm going to talk a little bit about those sorts of funds later. These are sort of ones which are having sort of what we call a deeper, higher impact in meeting needs in society which are currently pretty much unmet. So achieving that by really targeted and often smaller scale investment. So to unpack that broad class of responsible investing a little bit more, Ria have given you those subcategories. The way we think it can be helpful to understand different types of responsible investing is to think about the different tools that investors have to advocate, to influence positive change. And this diagram simply identifies 6 areas which I'm going to talk a little bit more about. ESG integration, screening, negative screening and positive screening, influencing companies, so that's engagement and advocacy, influencing government, what role can investors play in actually playing a positive role in encouraging more positive government policy, and then what I've called impact for the Sustainable Development Goals, which are this sort of deeper impact sort of work which we think investors, it's really important that investors consider that in their investing as well. So let's start off with ESG integration. What does that mean? And I think the best way to bring out what that means is by contrasting it with ethical investing. So both ethical investing and ESG integration will look at the impacts on people and the planet of a particular company, whether it's its products and services or the way it's producing those products and services. The ESG integration investor, if you like, they'll then take those impacts into account in their financial analysis of the company. So basically, they'll factor those impacts, positive and negative impacts, into their financial analysis, their valuation. So it'll affect their, absolutely will affect their assessment of risk of companies and potential returns. But ultimately, they'll make their final decision based on value considerations. Obviously, that'll depend on the particular type of investment philosophy that they adopt, but at the end of the day, it feeds into their financial analysis. If they assess that the price is right, they're still going to invest in fossil fuels, for example. Ethical investing sort of draws a line. Ethical investing says, okay, for some sectors of the economy, for some companies, it's not just a question of price for us. There's areas that we don't want to invest in. And we'll look to find positive, attractive financial investment opportunities in those companies and sectors that we assess to be contributing to a more positive future. So that's a significant difference. We think one of the benefits that ethical investing brings is it sort of recognises that for most people, their values aren't subsidiary to their financial goals. Whilst they're going to make a lot of decisions which are driven by financial considerations, the other things that are important to them, whether it's family, their local community, or people, animals, and the environment more generally, they're independently important to them. So ethical investing recognises that, and we think in an investment process it can actually be quite powerful. The challenge for ESG integration sometimes is how can, as an investor, you know that you really are taking those ESG impacts into account in your financial analysis. As we know, often financial analysis is as much art as science. So it can be easy when you're looking at particular sectors. If you're looking at the finance sector, for example, you've invested in it for many years, you've analysed it in a certain way, this Royal Commission comes on the radar, there's a drop in share prices. You sort of think, oh, well, that obviously there are some ESG concerns there around the conduct of some of these banks. I'm going to feed that into my model, but often it's going to look pretty attractive to you given the way you've looked at the sector in the past. So you'll sometimes there's a risk that you'll understate the downside risk, we believe, in our experience. So the ethical approach says, well, no, let's look at independently the way these companies are behaving. Is it good enough against our ethical principles, our ethical screening? If not, we're just not going to invest in you. So it sort of takes you off the table completely. That's the idea of screening, ethical screening versus ESG integration. Within that ethical screening approach, there's a whole lot of difference in how it's approached by different funds. What do you count as a positive impact that you're going to screen in, and what are you going to worry about from a negative point of view that you want to screen out? So this is where we find we get most of the inquiry from investors and their advisors around our ethical approach. What are you looking for when you're looking for positive investments, and what are you taking out when you tell me that you're screening out negative investments? So this is sort of maps at a very high level the sorts of things that we're screening in and we're screening out, applying our ethical charter. So just to give you an idea of how we approach things, we have an ethical charter of 23 principles which have governed our investing since Australian Ethical was established over 30 years ago, and that leads us to this approach to positive and negative screening of different companies and sectors. And I guess the contrast there is with companies which have much narrower screens. So we've seen growth in some ESG branded ETFs, which is good to see. But it's important, if you're looking at those or your clients are looking at those, to look at the detail of what's being screened in and out. So we've got some ETFs which will just screen out tobacco and cluster munitions, for example. And that's might be what someone's looking for. Often investors are looking for broader screening than that. So I've thrown up a slide there which might have you scratching your head a little bit. This is from Kate Raworth, an economist's book, Donut Economics. And I think for us, it's just a useful way of representing the holistic way that we think about ethical investing, that it's not about just picking out specific screens, one or two negative screens, a small number of positive screens. We think a holistic approach is important. If we are going to build a better future, we need to think about two elements. The outside of the donut, they're listing things like land use change, climate change, freshwater use. They're the environmental constraints, which increasingly, as we consume more, as population grows, we're bumping it up against that environmental ceiling. So we need to make sure that we're investing in a way which doesn't break through that ceiling and results, for example, in runaway climate change. In the middle are the social foundations. So these are the people element of ethical investing. How are we ensuring that people are achieving, meeting their basic needs are being met, whether it's around food, health, water. What are we doing around equality, around opportunity, equality of opportunity, strong education to provide those opportunities. So not a bad way, if you have someone thinking broadly about these things, for them to sort of give a bit of order to what's important to them when they're making an investment choice from a values perspective. So I want to move now on to another one of those tools which investors have to achieve change, advocating for change. So this often called as investor advocacy or investor engagement. So this can be with companies, it can be with the public at large and governments, can be trying to get companies to do a better job of managing their impacts, can be with companies to get them to do a better job of introducing policy which is going to drive positive change across the economy and society. I'm thinking about climate policy in this country when I say that. Investors have a really powerful voice, both with companies and with government, because they're not special interest groups. We invest, particularly superannuation funds, invest right across the economy. We're long-term investors. So if there's a particular sector which basically is going to disrupt and cause volatility in investment markets and society in the longer term, then that's going to be an area that that we want to stay away from, irrespective of whether there might be short-term revenue opportunities in that sector. So we think we have that sort of broad, responsible voice which can be powerful. It's not a special interest group either on the corporate side or on the NGO side. You know, not to diminish the importance of those voices, but that investor voice we think is very powerful, both with companies and with investors. And we think that's a really important tool that ethical, responsible investors need to exercise, whether it's in relation to climate, whether it's in relation to human rights. We've seen a lot of investor action around modern slavery legislation this year, and some positive developments around the way companies are managing human rights impacts in their supply chain. We'll, tend to think of that's happening in offshore and developing economies, supply chain over there. But, in recent years, we've seen a lot of concerning practices around treatment of migrant labour in food supply chains within Australia. And that's where we're seeing some really positive action, both by governments, legislative action, but also companies around the way that they're changing the way they interact with labour hire companies. And that's an important influence that we think investors have exercised there. So I guess I want to finish up a little bit with saying something about how, when you're looking at a particular fund, you might taking those different areas of investor action into account, you might look to differentiate between funds and try and decide whether this is a fund that's appropriate or not for a particular area of client need. And I guess the first warning to sound is, in this space, you really can't rely on the name of the fund, the label, just as you wouldn't when you're looking at the financial characteristics of a fund. You can't do it when you're looking for a responsible or an ethical fund. VW, sold a lot of cars with the tagline "Clean Diesel," but clearly we know with the benefit of hindsight that those cars were not clean diesel cars. So I guess trying to think of it in terms of matching a fund to your client's needs or your client's objectives, the first thing you need to do is understand what the key ethical issues for your clients are, and for most of your clients are. So this is some research that we conduct annually, trying to identify what are the key ethical hotspots for both our clients, but for Australians generally. Climate change, obviously a big one, but a whole range of other ones which figure prominently as being things that people are concerned about. So if we assume that most clients are going to be concerned about impacts on people, animals and the environment in some way, then how do we work out whether a fund is managing its impacts in those areas or not? We actually need to look at how the fund is reporting what it's doing. It's called itself an ethical fund or a sustainable fund or a responsible fund. How do you know if that's true to label? So first of all, you've got to look at where it's investing. There have been, continue to be some sustainable options which are very close to sustainable options of fund managers, which are very close to mainstream funds. So they'll screen out a very small number of companies that might meet the needs of a client who's looking to just stay away from the most egregious negative impacts. For others, it won't be. So it's important to see what companies the fund is and isn't investing. So this, I'm going to sort of introduce the sorts of things to look for by using some of the reporting that we give each year to convey to our stakeholders, including obviously our members and clients, the impact which our ethical charter has on our funds. So the first thing to show is, across sectors, it's going to mean that, we look quite unlike a mainstream fund or the index in terms of sector allocation. We're overweight healthcare, IT. We're way underweight materials because of our very low or currently zero exposure essentially to mining, the mining sector. So showing basically, where the rubber hits the road, how does our ethical charter make a difference to the sector breakdown of our portfolios. We also list all the companies we invest in on our website. The other, beyond looking at where we are and aren't invested from a specific company and sector perspective, we also try and measure, well, what does that mean in terms of the overall portfolio impact? Climate, as I've mentioned, is really big consideration for many investors. So we spend roughly 10 pages in our annual sustainability reporting explaining how we're responding to climate change in our investment process and how that's affecting our portfolio. So I've just grabbed a snapshot of the carbon intensity of our share investments relative to the carbon intensity of the benchmark. So we're about a third, currently sitting about a third of the benchmark, and we'll continue to track that carbon intensity over time. But if you're interested in that area, look at our sustainability reporting. We report against a whole range of climate and carbon metrics. Another, moving beyond climate to social impacts, people are increasingly, and a range of funds are looking at the Sustainable Development Goals as a way of measuring and reporting impact across a more diverse range of dimensions. So for those of you quickly who may not be familiar with the Sustainable Development Goals, these were agreed by countries, governments internationally at the end of 2015 to identify some of the areas of deepest need and challenge in society and in the environment globally. So areas where business as usual just wasn't solving some of these entrenched problems, whether it was around hunger, around emissions reduction to deal with climate change, pollution, and so on. So some investors are using these in a couple of different ways. One way is to report the way that they are having a positive impact, or their investments are having a positive impact. They can track in some way the impact that their investments are having against these goals, and that can give people looking for an impactful fund or a responsible fund a way of comparing funds. So we've done that again in our annual, this is from our latest annual reporting. We use MSCI ESG data to generate these numbers. So MSCI track the revenue that companies earn against these sustainable development goals. So easiest to give you an example, alternative energy, renewable energy, they look at companies, okay, what sort of revenue are you generating from renewables? And they'll track that. We then aggregate that data and say, okay, our portfolio, for $1 million invested in our portfolio, is generating around 24 grand's worth of revenue per annum, or did last year, from wind, geothermal, solar and hydroelectricity. These are the companies, some of the key companies which are generating that revenue, and then we benchmark that to the market, our benchmark indices. So we have a blended benchmark of the ASX 200 and the MSCI World, and yeah, that sort of revenue is about 9 times what a market investment in the benchmark, that blended benchmark, would give you. So someone can look at alternative energy efficiency and so on, and decide, okay, this is what Australian Ethical's approach is delivering by way of additional impact or lesser impact in these key areas. So it's mostly a really positive story. Nutrition, it's not a positive story. Now, partly that is because some of the food companies we invest in are not covered by MSCI, and this is an issue also in the healthcare impact area. If they're smaller companies, MSCI may not have data for them, so we exclude them. In the nutrition space, food is also just a very positive area for us to invest ethically, given the range of environmental and social impacts which a lot of modern food production has. And sorry, I should mention animal impact as well, being a key consideration as well. So that's a tool both for us to communicate to people how the Charter is having an impact, how their investment is having an impact, but also it's a management tool for us to say, okay, yeah, what does that look right in terms of the impact expectations we have for our portfolios, and if it doesn't, in the area of nutrition, yeah, how do we really look harder to find those positive food investment opportunities that we can develop additional impact in that area. One and I'm getting close to the end, so I hope we've got some questions coming up. I've spoken about the positive impact that that funds have and can report through the companies they're invested in and their carbon footprint, the sustainable impact revenue they're generating. Alongside that, we think it's really important for funds to tell their members, and indeed tell the public at large, why they're invested in those companies and sectors. Sometimes it'll be obvious, sometimes it won't. But yeah, what is their stance on particular issues, whether it's around animal welfare, live export, mining, fossil fuel investment, nuclear, and so on. So a key part of the transparency we aim to deliver is to just set out in a really clear, concise way our position on these key issues. So I think currently we've got about 30, 40, 50 of these key issues on our website. You click on the box and you see what Australian Ethical thinks about these things. And so we think it's really important, yeah, that funds are able to answer those why questions. You include these companies, you exclude those companies, why? That's our website platform for communicating that information. I've talked about our sustainability reporting. Social media is also another big channel for us to get our information out there. The beauty of social media is it's a two-way conversation, obviously, so it's a way for us to tell people what we're doing and why. It's a way for our members and others to come back and challenge us on that. Sometimes to agree and praise us, sometimes to say, but why are you in this company and why aren't you in that one? So it's a really powerful tool for us. It's something that our members take up disproportionately compared to other members in other funds, and I guess that graph shows that there. The level of engagement we have with our members really does dwarf most other funds, but we think that's changing. This is in line with the rise of responsible investment. People are asking more questions, and so we're seeing other funds improving their communication on that front, which is great to see. The final thing I will mention is our foundation, and I guess I'll wrap this together with a discussion of a quick mention of what we see as deeper impact. So broadly, we look to have impact across all our investments, positive impact, and obviously to minimise negative impacts. There is this deeper level of impact which we all need to strive for, we think, to meet those sustainable development goals, those deep challenges which mainstream business, which business as usual is not achieving. One way, so we look to do that across the public funds, but the other way we look to do that is through our foundation and our community grants program, where we direct 10% of our profits every year to social enterprises, to not-for-profits who we think are innovating in these areas and having impact in areas which aren't being adequately addressed by the for-profit sector. So a really important part of what we do as well. So I'm going to wrap up there and move to questions. Now we've got a couple of questions online. We did get one question ahead of the webinar, which was great. So let me start with that one. The question is, can we address why Westpac and NAB, why we invested in them? Both banks achieved 2 stars out of 5 in the Lafferty Global Report, both rated in that report 0 for culture and digital dependability. So banks are a really tough area to invest in from a responsible investment and ethical investment point of view, and that applies to the big 4 banks. It applies to all the banks, I guess. The way we've analysed the Banking Royal Commission and some of the quite shocking revelations that has revealed, we've seen the big banks absolutely having a lot to answer for. Equally, the smaller banks which have appeared, and also insurers and other financial institutions, I guess have dropped the ball in different ways often, but they've all dropped the ball in really significant ways. So it's a challenge across the sector. We continue to be firmly of the view that responsible banking is a really important part of the economy and society. It's a really important enabler for individuals and for business to innovate, to achieve what they're looking to achieve. So how do we then decide that NAB and Westpac are in at the moment and CBA and ANZ are out for the moment? Certain other banks are in, certain other banks are out, both locally and globally. We have a quite detailed scorecard where we look at a whole range of things. There's a summary of sort of the dimensions that we look at, which we update on an ongoing basis. We're in the midst of doing it now with the annual sustainability reporting of the banks coming out. That looks at the way the banks are integrating ESG in their corporate lending, looking at the way they're treating their customers, looking at their climate alignment. So how is their lending activity aligned or not aligned with a transition which limits warming to below 2 degrees, and increasingly with how are they focusing on 1.5 degrees as a target, given the recent IPCC report. And we're looking at the latest year's data. We're looking back 3 years at their lending to fossil fuels. Is that trending down? How's it trending down? How are they supporting positive investment? So applying that, we've NAB and Westpac have got the tick. At this stage, we take into account a whole range of information to build that analysis. We look at the bank's reporting. We look at NGO reporting. We look at financial ombudsman complaints reporting. We look at the ESG data providers and the analysis that they do, whether that's MSCI, Vigeo Eiris, CARE, Sustainalytics. Taking that all into account, that's where we've landed. The approach we're taking with the information coming out of the Royal Commission is this: if there is something that on a standalone basis we say is enough of a reason to divest, then we will divest. But when we're dealing with large complex organisations, there are things happening all over the place. The decision we need to make is it more isolated? Is it more systemic? And we think the best way we can make that call around the big banks, large financial institutions, is letting the Royal Commission conclude. There's one more session to come. We're going to get the report from Commissioner Hayne in January, February. That's when we'll take that into account, and we'll conduct our review across the banks that we invest in Australia. Sorry, just to mention specifically the Lafferty Global Report. So they're a subscription service. We don't have access to that report, so I can't comment the detail of how they've ranked the Australian banks. They do say that they just base it on the annual report, and I think there's some merit to do that. You expect the banks should report everything that's key in their annual report. But it does leave out a lot of broader and deeper reporting that the banks do in their sustainability report, their sustainability performance reporting. Banks have massively expanded the amount of data they're putting around in that area, and that's the sort of data we look at when we come up with our overall score and assess the banks against the charter. So should I just have a quick look through the other questions we've got online? So the AUM growth is one question. Is that new funds added, or does it include investment growth via returns? It does include both. It includes growth via returns, growth via inflows, new funds being established. But when I gave you that ballpark sort of doubling every 3 years, if we look at that Australian context, in percentage terms, we're basically seeing that doubling as a percentage of the total market. We're seeing that doubling happening every 3 years. So it's growing both in absolute terms, but also as a percentage of the total investment market. Another question: do you not think there is value in investing and then actively voting and engaging with the firm to change their practices? An energy company moving away from coal into green energy. Doesn't using an ethical stance and not investing remove your voice from advocating for change in those companies? Okay, great question. Comes up a lot, and there's, people get quite impassioned debating it. I guess two responses from us. One, listen, we think there's room for both approaches. We're very clear that, if ultimately you don't cross the ethical line with us, we won't invest in you. The fact that we're doing that and others are doing that, we think actually helps the engagement. The fact that there are those consequences that people walk away with their capital actually makes the engagement much more powerful. So we think that divestment movement has been a really important factor in banks being much more receptive to investor engagement. The other point to make is that we do engage with companies that we won't invest in. So we're finding increasing appetite from companies to come and talk to us because they're aware of the way things are shifting, so they're interested in our perspective. We have a capacity to buy a nominal holding of shares in companies which don't meet our charter, so we could buy a couple of $100 of shares. That'll give us the opportunity to support a shareholder resolution, to turn up at the AGM as we did, for example, Origin Energy. We currently exclude them. We're at their AGM asking about their climate planning and challenging some of their assumptions. So that's what we would say about that question. Probably the last one, given time, how do you consider property trusts in an ethical context? So we look at the sustainability of property. Well, two things. I guess we start with what's the property for. So if it's a special purpose property, an industrial fund which is catering for an industry which we consider to be negative, then we'll screen you out. So I guess if it's a warehouse facility for, I don't know, for fuels that we screen out for fossil fuels, we're not going to invest in that. But for general purpose property funds, whether it's industrial, retail, commercial, residential for that matter, we look at the sustainability of the properties that are being developed. So that's very much the emissions intensity of the properties that are being constructed. So yeah, how are you looking compared to, one thing we do look at is just the average. What's the average energy efficiency, water efficiency, Green Star rating of new buildings? If we're looking at a property developer, how do they compare with that average? For funds which are investing in existing properties, then we look at what's their record on refurbishing, upgrading the energy, water, etc. efficiency of those buildings. So that's generally how we approach ethical investing. Property investing. So I'm going to wrap up. I'm going to hand back to Leah. Thank you very much for your time. If I've raised things that you have any further questions about, just reach out to us, obviously, and we're very happy to provide further information.
Thanks so much, Stuart, for this morning. I hope everyone got some value out of that. I hope that it gives you some more insights into how to navigate all of those options that are coming to market at the moment. If you do have any final questions, feel free to come back to us. We will be sending out links to the webinar post this. So if you did want to sort of review any of the material or forward it on to anyone, feel free. But otherwise, thank you so much for taking an hour out of your day. We hope you found it valuable, and please feel free to reach out if we can help you out in any other way. Thank you.